Good evening, friends. This side Rahul Magan here as a Group Chief Executive Officer, Treasury Consulting. As we speak, Treasury Consulting is a multi-asset and multinational proprietary hedge fund. Of course, we do have many other business streams as well, like trainings, our pension fund desk, our consulting business, our private placement platform, and many more things. But having said that, when it comes to multi-asset, it means that our hedge fund desk taking positions in gold, silver, platinum, oil and gas, natural gas spreads, base metals, agriculture commodities, exchange for contract for differences, equities, foreign exchange, and multiple. By multinational, we mean we actively take positions in United States, Europe, and Asia Pacific region. But like I repeated many a times, and I would continue to repeat all the times, that we are a proprietary hedge fund. By proprietary, I mean to say no third party. I repeat, no third party can invest capital in our fund. Treasury Consulting and none of the subsidiaries of Treasury Consulting is asking any third party to invest in our fund. Please do take a note of that. Guys, today I would be covering a very important thing which is getting murkier and murkier every possible day in India. But in this video, I won't be naming the organizations, but I am giving you appropriate hints. We all know that in India, the startups are allowed to raise money from the public. We have seen Paytm, Zomato, Policy Bazaar, Nykaa, Delivery, Car Trade, and probably in the coming period of time, we have many more startups who are already approved by regulator and they would be coming up in public, like Oyo. Guys, when startup raise the money, from the market, they have a concept called lock-in period. Now, what the hell is lock-in period is that the top institutional investors, those who are investing in, so let me give you an appropriate or a hypothetical example. Suppose there is a startup called X. This startup is raising money from the market and institutional investors, hedge fund, big people are also investing in this IPO. Now, first of all, 99% investors are having zero understanding of the difference between IPO and OFS. OFS stands for offer for sale. For majority of the people, IPO and FPO are the same thing, but both are like Singapore and Somalia. Name is starting with S, but the way they operate is completely different. We also need to understand very clearly that in case of IPO, the fresh shares are being listed for the public, which technically means equity dilution from an angle of promoters, while in case of OFS, which is called offer for sale, existing investors, which could be private equity, venture capitalist, or probably promoter himself, is selling his stake, or maybe trust which is operated by the promoter's board, or promoter's family, they would be selling the stake, and in this regards, the fresh investors came by. In India, in the last 2 to 3 years, ample of evidences happened when promoters as well as the existing investors sold their stake, while our beloved media titled this as IPO, initial public offering. Technically speaking, this is called secondary IPO, not IPO. Anyways, people do not understand the difference. They believe in media, so let them believe in media. When you invest in a startup, you first see the lock-in period. Generally, the lock-in period is same. It varies from country to country. But please do understand that when the first of all, what is lock-in period? Now, lock-in period means that the institutional investors or probably the hedge funds or maybe the top investors, they cannot sell before this date. It means, let's take an example of Paytm. Paytm is losing. One of the reason is very clear is the lock-in period. Another reason is the performance. Third reason is the losses after losses on a sequential basis, as far as the Paytm and many more Indian startups are concerned. Now, what happened when the lock-in expires? The top investors continue to sell, which drag the stock down, to the highest level. And unfortunately, I would say majority of the retail investors are having zero understanding of that, so that they do not understand that what the hell is happening. Example, last week SoftBank sold 4.5% stake in Paytm. Many investors sold their stake in Nika, and you name the startups in which it is not happening in India. Today, I was reading one of the articles by Money Control. I would have separate video. In this articles, 2 lakh crores, you heard me very right, 2 lakh crores worth of investors' money is lost in these young companies where investors invested. I'll have a detailed video in this regards. Please be rest assured. You know what happens when investors invest? They should understand that there is a concept called lock-in. And once the lock-in expires, then the top investors will definitely quit. And they are waiting by the time. Example, in case of Paytm, which got listed at 2150, people thought, JP Morgan and many more so-called analysts, they continuously gave the targets to the Paytm, that Paytm would be this, Paytm would be this, Paytm would be this, and people just believed on that. At the end of the day, what does happen? It's all gone. It's zero, right? So investors who are well versed, investors who are knowledgeable, they track the lock-in period. And once they track the lock-in period, in this eventuality, what will happen that they would be able to save themselves from that. So let me give you a few examples of the lock-in period. Suppose you're investing in a stock and the lock-in period is 6 months, assuming. And what would happen immediately after 6 months? And the top investors started quitting. Now what do you do? Tell me. You won't be able to do anything because now the investors started selling and the stock will fall. Let's take an example of Paytm. Paytm share price is, if I'm not wrong, is approximately 480. And it is consistently falling. It means, according to the public information, around 80% of the market capitalization of the Paytm is already eroded. Congratulations, 80%. And now there are news coming that the Geo Financial Services is also coming up in the public, which means that it would put extra pressure on the Paytm. But as we speak, I'm not sure about the business model of the Geo Financial. So once the business model would be in public, then in that I would be able to let you know. But having said that, those who invested in Paytm and those who regularly track the lock-in period, They must be aware that in this lock-in period, many new investors coming, but the existing investors are waiting because they cannot quit as per law. In this eventuality, the very important thing which you need to learn is that you need to track what all is happening after the lock-in period, like it is happening in Paytm and many more startups in India. Please also remember that if there is a consistent selling which is happening after the lock-in period, it means the stock is going to be busted very soon. Busted in the sense it would fall down. Another beautiful thing which is happening in India, companies now started manipulating the market, which means to stop the investors not to sell, companies offering the bonus shares, splits. Why do you offer bonus shares and splits? If you are a great startup, if you are a startup of profitability, if you are a startup who one day can be Apple, probably Amazon, like in case of Paytm, many people said one day Paytm would be Amazon of India, and you know what kind of things said about Zomato, Policy Bazaar and all, then why are you offering splits? My question is that, guys, when organizations, especially loss making, offering splits, I'm not talking about Paytm, Zomato, I'm talking about some other organization. When organization loss making offering splits, bonus shares, it means, and that too before lock-in, it simplistically means that there is something which we need to consider. But you know the reason? Even once you open the split, the share price fall proportionately. And when the share price fall proportionately, then what happens? Very, very, very stupid thing is that people came in market and people buy that stock. And once they buy that stock, what would happen? They all lose. Let me give an example of three stocks. Number one, Amazon, Google, and you take an example of in India, Nykaa. Amazon did split or bonus. People invested. Reason? Amazon is a number one e-commerce platform of the globe. Amazon is 100% profitable company. Amazon works almost across the globe. More importantly, Amazon hold a substantial cash in the balance sheet, which signifies the financial power of Amazon. When it comes to Google, the story is almost the same. So in the first two cases, they both saw the heavy participation from the retail investors, because at one given point of time, Amazon was $3,600 per share. It is outside the reach of 99% investors. Google was also around $2,600. It is also outside the reach of majority of the investors. They did the split, and see what the retail investors are participating, which is good for the companies because their balance sheets are fundamentally very strong. That's the most important thing. Let's talk about Nykaa. 99% people do not knew that Nykaa holds negative retained earnings. Why? We do not know how to study the balance sheet. We do not know how to study the equity component. We do not know what the hell is other comprehensive income. What the hell is comprehensive income? We do not know what is negative retained earnings. We do not know what is the impact of negative retained earnings on the organization. We do not know anything. And Nykaa issued the bonus in the public domain. What happened? A stock which used to be 1800, 1900, you see where it is trading today. People entered because they saw 5:1. But guys, please use your mindset. So what I mean to say, stock split and bonuses are done by two set of companies. One, the companies like Amazon, companies like Google, or probably in future Apple also. Guessing. I repeat, it's a guess. It's always good to invest in these companies because they are tried and tested companies, profitable, billions of dollars they are holding in their books, and more importantly, they work almost across the globe. They have their patents, they have their technologies, strong business model, and so on and so forth. But the companies like Nika is also opening the bonus shares. Should you be investing? Just please look at the balance sheet of Nika and read it carefully. You would yourself get to know. The problem the problem we are having is people do not understand the balance sheet. They simply go and see the bonus shares and they buy it. End result, we all know what is happening with the startup story in India. So, guys, please do understand that bonus or split is of two kinds. One is by a well established company like Google, Amazon, or probably in future we can have more. One is by a company who is in losses, either PAT or negative retained earnings. 2 lakh crore, 2 trillion, of course the separate video would be coming. 2 trillion is being lost. 2 trillion is being lost by our investors thanks to the investment in the new technological companies. God forbid if the central banks would continue to hike the rate the way they are hiking. In this eventuality, the big depression is not far. And once the depression comes, we all know what would happen. Like I said, my fund not invested a single rupee in any of the loss-making startups. Because we know that once you are not profitable after inception, after so many years of inception, how can I expect you become profitable after IPO? And this is what is happening. Anyways, this is the message which I would like to pass to update the investors, to let them know what is happening, so on and so forth. This is Rahul Magan from Treasury Consulting Group. You knew my personal number, +91 9899 242 978. In case of more information, you can visit our fixed income platform www.fixedincome.global. I repeat, www.fixedincome.global. Thank you very much and have a great time ahead.